Welcome to Wall Street Wildlife Podcast, episode 13, where I'm going to tell Christoph why he is a fucking idiot.
I can't wait. I can't wait, Badger. Let's do this. Let's do this. You're
There's
a
no
fucking
nice way
idiot. You're a
to...
fucking idiot. You're an idiot.
Yeah, that's right. Get him, Badger. Get him. Get him.
Get the fucking thing away from me.
You fucked up, man. You have fucked up so badly. You have missed an epic run in the stock market that everybody else and hopefully our listeners have benefited from. And you are on the short train to doom, my friend. What are you doing? This is an intervention episode.
Oh, shit. It's that bad, isn't it?
I don't even care about your King of the Jungle portfolio and how deeply in the hole you are and the fact that I'm probably going to win this no matter what I do now. I'm worried you fucked yourself.
Well, that's partially true. But forget, for our listeners, if you miss some of the details, the majority of my value is in Chainlink, and Chainlink is up 170% this year. So I'm not about to be dumpster diving quite yet. But that's besides the point. In the stock market world, I sold at I couldn't have timed my sell worse. I sold like at that nadir in October, right before the market went straight up. So it's cost me a shockingly large amount of money.
I don't want to trigger you here, but I'm just going to pick on one stock in particular because we talked about this in, I don't know, episode 4 or 5. I literally pulled my hair out when you said you had sold your position in CrowdStrike. And like if you sold in, what did you say, September, October, the stock is up 100% since then. It's now the second biggest position in my personal portfolio. It's playing for my ski season and many ski seasons to come. And you've missed that train. And there's many other stocks in your portfolio you've sold that are incredible high quality companies, and you've missed the train with them.
Yeah, and in hindsight, it's devastating. I mean, I'm a firm believer in CrowdStrike. I've owned it for years and years and years. And the first time ever in my investing career that I added up the macro picture and I had PTSD from what I lived through in 2008.
How do we fix this, Christoph? How do we get you out of this hole you've dug for yourself and you're continuing to dig? The market's still ripping.
Well, let's pump the brakes though for a second. Let me just say that we're investing to end today. You would be right, I would be wrong. You would be rich, I would be poor, and I'd have nothing more to say. However, the show must go on, as as the great Wolf of Wall Street once said. Let me just draw an analogy for you. There was such a thing as the tulip mania, correct?
Correct.
Meaning human beings are the kinds of creatures who historically repeat cycles where the fundamentals of value and price diverge. And in the moment, if you're in the Netherlands, the only thing that you wanted to buy were tulips, and you paid exorbitant amounts of money. And after a while, like, humans get psychotic, right? Tulips don't. I mean, money is a made up thing, right? But anyway, that's the most famous example of a bubble, right?
What are those things? What were those crypto things in the last couple of years? Bored apes. This is not bored apes. This is real high quality companies delivering exceptional results. And if it's a CrowdStrike in like a macro environment that's going to support their continued growth, because like every company needs cybersecurity. Just one example. We could pick 10 examples.
That's right. But here's so let's put CrowdStrike to the side for 1 second.
Sure.
Because half of that, I admit, it was wrong to sell. However, let's take a look at another contemporary stock at the moment, Abercrombie and Fitch. Have you looked at Abercrombie and Fitch's chart? I mean, its price trajectory.
I have no idea. I'm kind of too old to go into those shops anymore without getting like weird looks. Yeah.
No, that's right. Abercrombie and Fitch stock ticker ANF is not one of the world's highest companies, but it's worth several $billions, and it somehow gained something like 200% in a very short span. CrowdStrike's performance, as you know, has been stellar for the last many years. But the price, in other words, the value of CrowdStrike did not just increase 100% in the last, what is it, 4 months? The big shift was in 4 months, right?
Sure.
In other words, what's expanding obviously is the multiple that people are willing to pay for the fundamentals.
Well, the fundamentals have improved. I don't know anything about Abercrombie and Fitch's stock, but like the revenue generated by CrowdStrike is up nicely in the last quarter. I'd need to go and pull some charts to tell you exactly how much, but like the
Right.
business fundamentals have improved.
Have they improved 100%?
No argument. I'm going to pull the chart and we'll see, but no argument. Multiples and expectation is high in the stock market, but that doesn't mean it can't keep going higher.
Well, that's true. That's the problem here in a sense, is that once you divert from fundamentals, and this is another point we need to return to what
Yep.
the reason one can make money in the market is because there are moments of exuberance, and overly exuberant optimism and pessimism. Those who take the long-term approach tend to average out between the overly bought and the overly sold, right?
Yep.
But in the end, don't we both agree that things always revert back to the fundamentals?
Yes, no doubt.
Right? Like that's what drives.
But you could be sat on the sidelines with any of these high quality companies while they continue to rip, and we can get back into macro, and you've got lots of legitimate reasons why you think macro is going to hurt the equities, like hurt the stock market. But if interest rates continue to come down, that's going to be the biggest driver of continued gains. And you could call it a mania, and I could look at the same thing and call it just a reversion to growth. I could see another year of gains from here.
Okay. Now, let's be very careful here. You said, correct me if I'm wrong, uh, if interest rates continue to go down.
Yep.
When have they gone down?
They're stable at the moment, and the forecast is they're going to come down.
Right, but now this is where I'm going to hold you to your word. You said continue to go down.
Okay, right, fair enough. Maybe I misspoke, but
right, but that's an important point. It's not a subtle. This is where it gets really tricky. I think from my perspective, if we're in a period of the stock market that is untethered from fundamentals, then what is driving it is perception, storytelling, narrative, right? And what the narrative is, or what's being bought, is that interest rates are going to go lower.
Yep.
And what's interesting is you said it as though that's already happened.
Sure. Okay.
Which is an interesting observation. But not only has it not happened, but the narrative around why it will happen, I think, is problematic, because much data does not support that. So what I'm saying is, in the short term, it's almost like, I wonder if this is the problem. In the short term, you could both win and lose, like at the poker table, because you get good cards or bad cards. What I'm saying right now is, those who are buying equities now because their card streak is hot will pay a severe price because their cards do not match the fundamentals, even with a company like CrowdStrike at this moment. Or we could talk about NVIDIA, because I think we both made the same mistake of selling because we looked at that company. We said, we love it, we believe in it, right? And yet it's now gone up how many hundreds of percent?
Okay, let's get into that one because I think that illustrates a sensible place where we're going to end up with this conversation. Um, because we both looked at Nvidia, and I'm an Nvidia bull even today. We both looked at Nvidia months ago, and we said it was overbaked. Um, and so, if I'm hearing you correctly, you sold your Nvidia position. I reduced my position by about 50%. So I've still benefited from like half of the gains because it's continued to run. Like it's probably up 250% from when I cut it in half in my portfolio. And maybe that's the difference. I'm not making these kind of all-in decisions. I'm keeping myself a little bit on the fence with almost everything. You painted an ugly picture of macro. Our guest, Mr. Nod Advice, brought that to life um, eloquently two or three episodes ago. But I went a tiny bit more cash, like 20% cash, whereas you went much heavier cash and you started taking short positions.
Right. So that's the thing. Well, also, and I added to my Chainlink position, which is up 170% over the last year. So
Sure.
I reallocated all my assets to those that I thought were not in bubble territory and were outside of the system that is, to me, flashing lots of red warning signs. And also cash, which is making 5% in my Robinhood money market account.
Yep.
Let's say hypothetically that the data I'm seeing turns out to prove correct, and we're going to see regional bank failures, and it's going to become another systemic downturn. It's 4 months from now, and my KRE puts my bet against regional banks are up, say 150%, and CrowdStrike and Nvidia dropped, say 40%, 50%, whatnot.
Sure.
That's I don't know, I don't want to say high probability outcome, but it's in the realm of the possible outcome.
Yeah, 100%. Yep.
It's an interesting thought exercise, I think. What do you say to me 4 months from now if that's the situation that we're looking at?
Well, I do this thought experiment myself. I try and visualize how I would feel. We haven't really talked about emotions, and that's like probably the key to this topic. I try to visualize how would I feel if my portfolio was cut in half, and so that drives my cash allocation. And so currently at about 22% cash today, I think I feel well balanced against probably in my mind. Okay, so your scenario is probably somewhere like a 10 to 20% scenario, like a fifth of the time. Maybe your macro hits hard, I get wiped out, and your short positions do great. So if that's going to happen in my mind, and this is all totally subjective, if that's going to happen like 1 in 5 times, I'm happy having 20% cash because I don't know that hedges me because 4 out of 5 times my stock's going to be up even higher, and my 80% invested money is going to be doing great. What do I say to you? I say, shit. Well played.
I mean, you know what I want to work through, maybe, to provide value to our listeners. We decided to talk about this because this is the most legitimate investing question on my mind right now. And it seems almost like foolhardy to talk about, say, the specifics of Apple Pro or Tesla's earnings, when in the big picture, I'm saying for the first time since 2008, so essentially what is that, 16 years now. COVID was its own thing, but in essentially 16 years, this is the first time ever as an investor that I allowed the macro picture to override my long-termism philosophy. And at the moment, I'm suffering for it badly. In hindsight, it was a terrible mistake. But investors now thinking of getting into the market, right? And they're listening to us. They're saying they're seeing Luke's portfolio's up big. He didn't panic. He didn't sell everything. Maybe I should buy CrowdStrike. Maybe I should buy Nvidia. Maybe I should buy what so and so. Then they hear me talking about, oh man, it's in the realm of possibility. Things could drop 50%. What what do you do? What do you tell an investor right now with some $1,000 in the bank ready to start?
My advice would be get started, dollar cost average, understand your emotional responses to what happens in the market, and take a long-term view. If you can do those things, you're going to wear, if you do them successfully and they're hard, the emotions being the biggest one, you're going to wear that downturn. At some point, the market will revert and will flip back to like panic and blood on the floor. And whether that's in 5 months or 5 years, I don't know. But that will happen at some point. And when those points come, that's when you get tested as a long-term investor, because you've got to keep the long-term view. And you just got to say to yourself, as I did in 2021, 22, like this too shall pass, and not panic and not sell. As long as they're good quality companies and you understand why what you own is still performing as a company, like the CrowdStrikes and the Apples and the Metas and the Nvidias fundamentally are still growing and succeeding and delivering real economic value in the world, then at some point, maybe 3 or 4 or 10 years after we drop 50%, we're going to be back up to new all-time highs.
There's a principle I would add. One of the rules of the jungle that Badger and yours truly are working on is if you only invest money that you don't need, Badger's strategy here, I think, is in the realm of what I would call still reasonable. That you just don't look at valuations at all, ever. You don't care that things are extraordinarily expensive and the global economy is very, very fragile from many perspectives. You just, because you don't need the money, you invest it. And over time, now we're talking about, I would say, no less than 5 years, but on the scale of something like 10, 15, 20, you will do just fine. I think the thing that I'm bothered by, that I can't get out of my head, is this stock market has essentially been carried now for whatever the last couple of months on the back of the massive conglomerates. So I'm talking about Nvidia, called Apple, Microsoft, Facebook, Meta just had great earnings, and basically Magnificent 5, 7, whereas the majority of the rest of the market has been small caps, have not done well. And I think the ratio of successes to losers are 2-to-1 losers to winners.
Good.
That's an uncomfortable view that lends to me credence that this market is, in a sense, artificially being held up. By artificially, I mean those with the billions of dollars in the funds are, I don't want to say manipulating exactly, because it's all a game. It's all. I don't want to lead this. I don't want to start talking shadowy stuff. But when the fundamentals have now diverged, meaning the economy is not growing, unemployment is problematic, interest rates are high, credit levels are high, to sustain these kinds of high prices, even for the best companies in the world, I don't understand why our motto of patience, in a sense, not understand, I mean, I do understand, but our motto of sometimes you need patience. You don't invest simply because you don't know what else to do. To invest now, in this moment, as opposed to saying, let me wait until we get either an improving economy, which would back the fundamentals, or proof that, yeah, it was unsustainable and you get better prices.
I'm
It's
just going to
that,
throw like that famous quote that we both know at you. Far more money has been lost by investors trying to anticipate corrections than in the corrections themselves, right?
yep.
The only thing I disagreed with when we had our vehemently disagreed with when we had our conversation with Mr. Not Advice a couple of weeks ago was his view that this time it's different and there are so many different dooms. I think really you could take any point in history and you could identify like a bunch of things to be pessimistic about. And if you let that drive your consensus on the market and your investing strategy, like you'll always find a reason to wait and not get in. And so my position remains, yep, there's some scary shit out there, but you've got to be invested anyway.
Yeah, in many ways, I'm arguing against myself because I believe so many of your principles. So, listeners, do keep that in mind. There's some cognitive dissonance for me. However, there's enough of the this time it is different that I actually do believe. And that has to do essentially because of the massive amounts of debt that the world has accumulated. It's unprecedented. So that, in a sense, if we just look at that one data point, meaning the amount of debt per GDP because of the stimulus needed since COVID to keep the global economy running, essentially. If you study systems at all, you know that when there's an input, it takes time for that input to actually show up, so to speak. If, to use a bathtub analogy, if you turn on the faucet, right, it's going to be, let's say, call it 3 hours before the bathtub overflows. But we know it's a problem, right? If the water is rising and rising and rising, just because it hasn't overflowed yet doesn't mean there's no problem. I try to think as best I can often in terms of fundamentals, the whole Elon Musk first principles. And I still believe in basic fundamental economic principle that you cannot have something like free money in essence without the consequences that comes with printing money out of thin air, so to speak. So what I'm saying to you in a rebuttal of sorts is I agree that this time is different is a problematic mantra, and I cannot dismiss the fact that the world's leading economy, the United States, is now paying more on their interest rates than ever before at a time when its constituents have more debt across their own balance sheets than ever before, and that has to somehow be accounted for.
I'm going to give you a facetious argument in rebuttal of that maybe it doesn't matter, and don't challenge this too hard because I can't really stand behind it. But the US has incredible wealth and assets, right? You let's just look at like the land value, like the physical value. Let's look at like the US's nuclear armament, right? The country has a ton of shit that is worth probably hundreds of trillions of dollars, if not more. So whatever debt the US might owe to other countries is kind of irrelevant. Like, I'm not saying you're going to go and sell Hawaii, but um, you know, but the country has significant assets. If you think of it in that way, if you think of, I own this enormous mansion which is so rich, and every room is full of incredible priceless treasures, and you're bothering me because I owe you like a couple of $100.
Ooh, that's really flawed. Let me ask you this. It's September 1929. and we're boozing it up, and things are great. And we think, man, the United States has a lot of land, and we're making these amazing new cars. The Ford, manufacturing plant is making all these cars, and the good times uh, are underway. What do you tell the people, that then lost everything, and for the next 8 years were jobless, homeless, breadlines, and all that? Why didn't the just sell the land theory play out? And
I'm not,
why did the Great Depression happen?
I'm not a historian. I can't tell you. But and was it really 8 years? I don't know if that's true. Um,
Well, yeah, World War II essentially was the
okay,
way the U.S. got out of the Depression. So
okay,
it was over a decade. It was about a decade.
okay. That is a long period. If we just stick to investing, not the other things that are going on, that is a long period that you have to wear as a long-term investor. But I'm probably pulling a stat out of my ass a little bit, but there has never been a 20-year period where being invested has delivered negative returns. So maybe I'm stretching like long term a little bit too far because 20 years is a long time. Like that's a chunk of your life. Um, there are probably very few 10-year periods, and maybe the Great Depression was one of the very, very few where you lost money if you were just invested in the market for a 10-year period. If you think we're coming into one of those, good luck to you with your short positions. I'm I'm kind of playing both sides of it, I think.
Yeah, this is a troubling moment in time for me. I don't want to be redundant, but up to now, you're obviously right. I deserve the serious ass kicking and intervention that you're trying to provide. I did stay invested, but again, in two companies predominantly that I felt were severely undervalued, plus what's it called? Not because undervalued, because basically the market was not recognizing their future potential. In the event of a major correction, that those values would not be compressed because they're already so small. So I did not take the, call it, completely panicked, sell everything and stuff my money under the cushion. However, the mistake was that in hindsight, that I sold excellent companies for ones that only had hope in the future.
Right.
So that lesson stands. Like you are correct in terms of principle there. I don't. Let me summarize what I think I'm saying. I think Badger, you're right. Holding long-term quality companies for the long term is a very successful strategy. I seem to be saying there are things like tulip manias, and it is not wise to invest when there's such a divergence from value and everything, all the other data, and that patience and being willing to tolerate not hysterical, but a kind of fear of missing out, manic. Oh yeah, stocks obviously were in the clear. The government says everything's in the clear. It's wise to look at like another principle is do your own research, try to understand as best you can what's actually out there rather than what people are telling you is out there. Analyze it for yourself and be okay with, for better or worse, employing, I guess, patience on both sides of this dilemma.
And maybe as we try and land this plane and wrap up uh, the argument and our somewhat divergent but also kind of agreeing positions, um, there are some laws of the investing jungle that you got to be aware of as an investor. Um, just like you said, don't invest money you need for the next 5 years. So we are trying to put these together and create a Wall Street wildlife laws of the jungle the commandments by which, if you live a wholesome life, the jungle will reward you in the long term. So, like, take our debate with a bit of a pinch of salt, because I think fundamentally we do both agree, and we're at a funny time in history. And if you're interested in reading the laws of the jungle, give us a month, and we'll have those live on our website, and you'll be able to download a copy.
Yeah, they're good principles. It's the hard thing about investing is it's one thing to know things, and it's one thing to even understand things. It's as human beings, it's another thing to always execute. And can I ask you about a poker? Maybe we love poker, and I think those analogies really really help. I'm trying to right now avoid the mistake of resulting. Right, which is the way we define it is if you have a process and you really do your diligence and you know how you want to invest and the outcome moves against you, but you played your hand correctly, it's incorrect to say that your process is wrong or that you're a bad poker player. You have to essentially say, no, the process was correct, but the what's it called? The probabilities were in your favor, but luck and chance went against you. That's kind of maybe, if I think about it, the way I feel in this moment. Let me put it this way. The results have been terrible for me. I don't think my decision, my half of my decisions violated principles that I agree with, but the reason I violated them to me still seems sound, and I am not yet, say, convinced that I was wrong. I will be wrong once we achieve the soft landing, and once once that is actually reality, I will say I was wrong in all the ways. But right now I feel like I'm still sitting at the poker table. The cards are not going my way. But I'm trusting my process at the moment, and it's hard because I'm losing.
Yeah, the analogy sort of holds up, I suppose. Like, you think, in this poker analogy, you think your opponent's hand is much stronger than I do. I see weakness, and I think I'm, and therefore I'm playing my hand more strongly because I think I'm going to prosper. Whereas you fear your opponent has quad kings and you're in big trouble. And so that's why you're being a bit more conservative. But you're right, like, until the cards are actually turned over, we don't know what the reality was.
Right, and I suppose I'll say one more thing. And, maybe this is another one of these, don't hold me to the fire exactly, but as far as my own economic understanding of the last, 60 years of the stock market, every time we've had serious economic issues and there was promise of a soft landing, it has been achieved exactly 0 times as a data set. Therefore, when I think to myself, okay, because the amount of debt we have now is higher than ever by far, and we've never achieved a soft landing, but what we're getting advertised is a soft landing, probabilistically, I'm thinking tulip mania. Because the stats, the data just don't support it. And I'm happy for this time to be different.
Yeah, no one knows. And even when it plays out, like, we don't know if that was a high or low probability outcome. It's the universe we ended up living in.
Actually, is that true? If something has never happened before, do we not know whether that's a low or high probability?
I don't know. Like I say, I'm not a historian. I can't refute your point without doing a ton of research. Have we never achieved a soft landing? I don't know.
That's correct.
Okay, right. Do we need to? Can we? You think the current environment is unsustainable?
Well, yeah. I mean that's what I'm saying. This takes me to a different holistic kind of speech. Prepare thyself. I hope I don't begin lecturing. If I do, just throw a rotten banana at me. There's I would call spiritual quality in the air, or meaning like a cultural quality that makes me very uneasy, which gives me even more fear about the situation, which is I don't think people's mindsets are properly, what am I trying to say? I think we've gotten into culturally in general into a habit of extending credit because credit is easily available, meaning consumerism is what people do. And all these rollouts of payment programs, from buying, I guess credit cards as the first step, right? But then the buy now, pay later stuff makes me really, really suspicious more than ever before that, yeah, I will, as a consumer, as long as I have access to somebody willing to give me money, then I do not have to worry about what it means to have a high credit card bill, because eventually somebody, like, eventually it's all going to be fine. Given that large framework, I don't feel good. It'd be very different, to put it a different way, if we were a civilization or a culture who was disciplined and, let's say, austere, or had the uh, mindset of, yeah, um, I want nice things, but right now I don't have enough capital, so I need to refrain, and live within my means. That piece is, to me, really worrisome. I don't know
Yeah.
if you disagree with that assessment.
No, I've always felt that way. I think we're getting into a different topic. But yeah, I fully support the fact that like lifestyle creep, and I don't know if it's an American term or not, but keeping up with the Joneses, like, spending money you don't have to buy a fancy car, um, that is an unsustainable way to manage your finances, and that's horrible. And I'm a massive non-fan of buy now, pay later, because I think that's hiding a big problem. Um, but that is going off the topic. Like, you're right. If that does unravel, that's one of the dooms, I suppose. A bit like, war, and a bit like corporate real estate. If that does unravel, at some point that is going to hit the stock market. It's a weird one. It's not going to hit a company like CrowdStrike directly, but it will indirectly, because fundamentally, consumer buying is underpins at one or two levels removed, kind of underpins everything else.
Yeah, it's all related.
Yeah.
As far as, I've watched The Wire many, many times, and that's a show about systems. And I think if you follow the money, as that show teaches you, you will get to the core. It's always about the money. And I guess I'm presenting the view that as valuations get stretched in the context of a slowing economy, plus a cultural lack of discipline, and I would say delusion, those factors combined make me very uneasy to invest in equities at this moment.
I guess we just have to see how the story plays out. Should we come back? Should we check back in episode 26? Like,
Yeah,
we've
well,
done 13 episodes, and another 13 episodes time, and let's see if we have to intervene once again.
yeah. Do you feel like your intervention has failed? Have you tried your best, and I'm just too too stubborn, too ignorant to kind of hear what you're trying to hear the Badger gospel?
Yeah, I think so. Yeah, hasn't landed.
So what you're saying is Monk is just too ignorant, and there's no hope for the poor creature.
get that get that rubber badger back out again, the furry badger. I want to see it attacking you once again.
We're
Exactly.
really
It's not
hopeless.
working. Your badger shield is up. But it's a good reminder to me as well, and to anyone who is invested, and they're more in the badger camp. You do need to watch fundamentals. I didn't pick you up on it, but earlier in the episode you said, like, valuation be damned. You can't ignore valuation. You have to focus. It's a critical part of an investing framework. So as my company's valuations become more stretched, I will continue to trim away at them. I did trim a little bit out of CrowdStrike like a few months ago. Um, and so I'll continue to increase my own cash position, but like, I'm mostly invested, so I'm going to get the benefit if the next 4 months continue to play out as the last 4 months did.
Okay. And speaking of portfolio updates, I will mention that I sold my position in Relay at something like 45% gains. And I did this because there's some data that suggests we're not going to get new positive results until the back half of the year. And I wanted to add extra cash so that I could add to my short positions.
Completely disregarding everything I said for the last 45 minutes. Anyway. But well done on banking the gain. I've sold nothing. I just continue to hold high quality companies, and I've got a bit of cash in reserve.
Or maybe I should buy some CrowdStrike just to confuse confuse us all. And then if I do, although the moment I do that, watch out. That's the way I could catch up with you. The moment I buy back CrowdStrike, we're done for.
Okay. Yes, right. Yeah, yes.
You want a 60% drop? I got you.
Oh, well, I think we should probably leave it there. I hope this was an entertaining discussion, and I hope somehow listeners have taken some knowledge out of our back and forth.
Yeah, and actually, before we go, let's just encourage folks who listen to this, chime in the comments section, either on X or on YouTube. We're playing around, but we're not playing around, and I think this is a legitimately difficult issue in this particular moment in time. And if you have some insights for us, questions for us, angles we might not have considered, please let us know. We really appreciate your listenership and your feedback. We're all in it together.
Yeah, give us a like, give us a subscribe. If you want to connect with us, you can find us probably on X is the main place, but we're on Instagram and a bunch of other TikTok. I think we're probably going to demise the TikTok. It's a bit daft. I'm on Twitter/X at 7Luke Hallard.
And I am at 7FlyingPlatypus.
And then go check out wallstreetwildlife.com, our nascent website, but we'll have the laws of the investing jungle published there in about a month's time. We've written 2 of the 10 laws, so we're beavering away at that as we speak.
And stay away from the rotten bananas.
It's a jungle out there. Be careful.
A reminder that the people on this program may hold positions in the companies that are mentioned. Buying and selling stock carries financial risk, which could include loss of capital. The views in this program should not be taken as personalized advice. Before acting on any of the information provided, listeners are encouraged to consult a financial or tax professional.